Hi and welcome to this episode of OmniTalk. Today we are discussing about scientific investing and how it contrasts with popular ways of investing, which include growth investing or value investing. So, Vikas, people are quite familiar and they've been hearing, and there are variants of indices like there is a value index, there is a growth index. If
True.
you talk about S&P 500, or there are these different ways of or kind of philosophies of investments have been popularized by great investors, right, including Buffett and so many other popular investors, right?
Hmm.
So somewhere I think people have gone taken this to a very far extent in terms of forgetting what are the basics of fundamental basics of investing, but just trying to be on some style of investing so that
Hmm.
they can predict where the next market returns, more market returns are going
Right.
to come from,
Right.
and position themselves or their portfolios without really understanding that what style of investing they want to
Hmm.
be a follower of in the long process, but just trying to maybe chase the returns or be optimized in terms of how they are allocating capital.
Hmm.
So let's try and understand that how scientific investing solves that problem in a very fundamental way, and also like understand what are the limitations and maybe a better part of these popular ways of investing style, right?
Yeah. So let's first understand what is the normal definition of value and growth, right?
Right.
So if you go to any of the index providers, they are typically popularize the value growth,
Hmm.
and also the people who kind of classify mutual funds, right?
Correct.
So it's an extension from the index classification because the indices are classified as value and growth, which
Right.
is basically if you take S&P 500 as an example, then the higher P is considered the top 250
Yeah.
above the average P are considered, or the median P
Medium
are considered growth, and then the bottom 250 are considered value,
value.
right? And same way, Morningstar or Value Research will classify whoever is comparing themselves
Medium.
to growth to that part of the box, style
Correct.
box, higher P and then the lower P,
Hmm.
right? So and that is one thing. That is the way typically it's classified. Secondly, there is this kind of a conception somewhere that in the bear markets, value outperforms,
Right.
and in growth markets,
Uh,
sorry, in bull
no,
markets, growth
no,
outperforms.
right.
So people try to have this thing that okay, I'll go into value strategies or funds,
Right.
whether ETFs or whether active funds during bear markets, and I'll try to then move into the growth style of
Right.
funds during bull markets.
Correct.
So this is broadly what
Hmm.
is the understanding. Of
Hmm.
course, this is too superficial.
Hmm.
It's wrong. It's nice for a classification and all that. It's clean.
Hmm.
That okay, above this is growth. But if you think about growth, then growth is revenue growth, earnings growth, right? Uh,
Or price growth itself. Right.
Price growth is then momentum.
Moment.
Now that itself, I we should have a separate
Right.
video about
Right.
growth versus momentum, etc.,
Right.
and where that fits in. But yeah, so price growth itself is considered as
Hmm.
growth investing
Mhm.
as well.
Right.
So this is all uh, not necessarily true,
Hmm.
right? Uh, Growth is a fundamental concept which relates to earnings, revenue, cash flow growth, while valuation is a combination of fundamental versus the value, right?
Right.
That is it cheaper than the fundamentals.
Right.
So there two parts are there, price and earnings.
Earnings.
While here it is technically growth should just have
Just
earnings growth, right?
right.
But a sustained earnings growth can only be there if there is a sustained revenue
Yeah.
growth. Otherwise, it will be short duration.
Right.
So it's mixing two different concepts. One is a fundamental concept, and one is a combination of fundamental and price,
Right.
which is value. And you're just mixing up. So it's all wrong
Correct.
way of
Correct.
looking at things. or an incomplete way, I should
incomplete.
say.
So yeah, so as you said, like there is a concept of growth in, because end of the day, if it all boils down to the cash flows and and either you're trying to invest in companies which are going to have growing cash flows at a maybe a faster clip than the market, or you are looking at companies which are available at a discount,
Right.
so that is, you're tilting yourself. uh, so obviously there is a valuation concept that comes in,
Absolutely.
becomes important, and there is a growth concept, right? and
Absolutely.
and for that matter, most of the companies are actually growing, right? What
Sure.
is
In a country like India, yes,
yes, yeah,
most country
right,
companies are growing. In a country like developed markets like US or Europe, it need
yeah,
not necessarily be true. Yeah.
true. But let's say if we can kind of broadly put up framework, a
Hmm.
simple one,
Hmm.
to say that okay, which is a good growth strategy, or which is a good growth company, and which is a good, let's say, value company, then how can we go about
Yeah,
that?
so we'll come up with a very crude framework that let's classify into quartiles,
Okay.
right? So you take the whole market and you take the median growth rate,
Mm-hmm.
which is typically going to be similar to the economic growth rate, right? Somewhere in median growth rate. And then you have the top quartile. I mean, then you slice the top half into two again.
Hmm.
So top quartile, second quartile,
Hmm.
these are above average growth rates or above median growth
Growth
rates.
rates.
And then third quartile and fourth quartile.
Hmm.
And you put growth rates also into this and the P ratios into this.
Okay.
So P ratios also have four quartiles, growth rates also have four quartiles, right? And the simple thing, very crude framework would be that if you have a higher quartile growth rate and a lower quartile P,
Hmm.
so let's say top quartile growth rate and second quartile P,
P.
that's a probably an undervalued company,
Hmm.
even though it's a growth company.
Correct.
Similarly, a third quartile growth rate and a fourth quartile valuation,
Hmm.
that would be an undervalued value company.
Correct.
Undervalued valued
Oh,
company, right? So this
right.
is one. There could be companies which are top quartile or second quartile growth rates,
Hmm.
but they are in
Okay.
the bottom two quartile of valuation.
Correct.
They are definitely growing companies which are undervalued.
Sure.
So you could think about some framework like this.
So we are
And
basically splitting them on actually the growth spectrum,
correct,
and
the
then
valuation
also
spectrum.
on the valuation spectrum, and then doing a comparative.
Correct,
Just leaving it at that, just because you have a high PE, you are growth, or just because you are low PE, and because then you run into problem of what we call typically like known
Value
as value
traps,
traps and growth
growth
traps.
traps.
So there, if you are buying a, like say, top quartile growth, then if you're paying the top quartile valuation, then again there's no fun, right?
Then you're most
You'll
likely at market
market
returns
return,
or
right,
lower.
right. So the idea is to then still have a lower quartile valuation,
Correct.
third quartile, second
Yes.
quartile. If you can get first quartile, then
Yes.
you can have like very high
Yeah.
returns. But and
So this
similarly,
is go
yeah,
ahead.
on the valuation side, you're saying that obviously by the definition, if you say value, then it has to be below the
Below the
median,
median.
and
Yes.
then you should still have some good growth.
Right.
Then it is justified, because otherwise the bottom quartile and the bottom growth is probably the fair valuation
Again,
for
it's
that
fair
company,
value.
even
Yeah.
if it is a
Yes.
value
It's the
bucket.
cheapest.
Cheapest,
It's still
right,
probably.
is the right valuation for
Yeah.
that.
Yeah.
Right. Great. So yeah, that could be a good framework. Just like cutting the market in half and just looking at the P,
Correct.
it's slightly more analytical and needs more kind of skill set, or maybe data access and stuff. But I think that's will definitely puts you at a higher pedestal than
Yeah,
just
you're better off than just the standard value and growth, where you
right,
could be in the growth trap or a value trap. We'll
right,
discuss that in some other video.
right,
Value traps, I think we've discussed a little bit. Growth traps also we can discuss somewhere else.
right.
And one more point, which again we'll have to discuss in another video, is that has growth captures extra value only in quality companies.
Hmm.
So that again is like a whole video. We cannot address that here.
Right.
What we should summarize here with is that while we have given this crude framework, the best framework, or in our opinion, is obviously to follow the scientific investing framework,
Right.
which doesn't distinguish, get into these kind of fragmented concepts of style, but rather takes the full, valuation framework. So you use the fundamentals, you do your projection of cash flows,
Right.
you include the concept whether there is a persistent competitive advantage or
Right.
not, and combine all of that to come up with an intrinsic value, and whether the price is at a discount to that intrinsic value, conservatively determined intrinsic.
Right. Right.
So this combines all the things in a proper scientific manner,
Right.
accurately.
Right.
So this is not a crude framework, this is a precise framework, accurate and precise, while that is a crude framework.
Correct.
What we just discussed.
Right. Great. I think it was a bit insightful, but these are complicated concepts, and it will need various discussions over maybe few other episodes that we will come up with.
Absolutely.
And try and treat each and every concept,
Yes.
so that you don't get you don't straight jacket yourself or bucket yourself that I do only growth because growth by the name should grow and should give me high returns. But end of the day, it is discount to intrinsic value, which itself is it's not that easy concept, because when we said growth, again, what growth, top earnings growth, free cash flow growth, top line
Absolutely.
growth,
Absolutely.
past growth, future growth for what horizon.
Sure.
Then how do you look at free cash flow, how do you do valuations, is it p multiple, is it discount to intrinsic value,
Right.
it is. So in itself it is quite complicated, so it will take time, but it's good to understand that there are nuances around just trying and bucketing things into very simplistic models, and that's where scientific investing comes at play, and looks at the most fundamental approach to investing. And hope it was insightful. Thank you so much for joining us.
Thank you.
So always keep in mind that investment in securities market are subject to market risks. Read all the related documents carefully before investing, and also that registration granted by SEBI, membership of BASL, and certification from NISM in no way guarantee performance of the intermediary or provide any assurance of returns to investors.